Good morning. My name is Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Jill Malandrino with TheStreet, and together we bring you the morning call. Including today, we have 4 trading days left of the year. So what we really need to do is check composure of the market to see if that down day we had on Friday is a change of the upward momentum trend we've seen since November 16th. I personally don't think so. But the question we have to ask ourselves as traders, do we lock in gains that we have for 2012, or do we come in and pick and choose our spots like we have been?
I think at this point, just traders are doing a little less. If you've been in portfolio approach ever since that November 16th low, they've given you really no reason to abandon equities. And I know Friday was harsh that morning. You know, on the Twitter sphere, everyone was going nuts. We were down, what, I think to 1390, in the SPX futures. But we wound up opening down almost 200 points in the Dow futures, and we closed only down 100. So that's what you want to see. You want to see dip buyers come in. I know on that abbreviated day, we were, down, 50, 60 points, but it could have been worse. So I think at this particular point, we worked off some of the overbought condition. I think, yes, maybe we got a little bit of a brushback pitch to clean up some loose positions. But overall, I still think that, holding a portfolio approach, trading around positions, having a few hedges on is the way a lot of traders like myself are trying to, position themselves moving forward. If you're here and you're not on vacation, just don't do too much. But if you're here, there's also probably some money to be made, but don't expect way too much.
I also think that's going to be a key for 2013 too, as we stick with that portfolio approach, because even though we do have that fiscal cliff language that we're probably going to be working through Q1 of 2013, there really are some great spots to pick and choose in the market, because we do have a lot of cash that does need to be put to work. But going into trade on Monday, how are we looking to set ourselves up?
Well, we have a long time, I feel, between now and Monday. At this particular point on a micro version, you look at the SPX, you go to the chart here, you will see that, here was that November 16th low. From there, what was it, 1343 all the way to the recent high here of about 1448. You see this downtrend that was in play ever since that 1474 high. We finally broke above it, and we're hovering right there. So I do think short term, it'll make it easier if we could hold above, just say 1415. Area right around here, because that would make it easier for guys like me to hold positions. So I think the longer we stay above 14, 15 and go sideways, the greater the chance that come the new year, like you said, when everyone gets a new flows and money needs to be put back to work, we get a move above, 1447, and we close above there, this 1474 could happen very, very quick. So this is your micro line in the sand, and this is a little bit more of an intermediate one right around there.
Moving along to the sector spotlight, we're going to check the temperature of the groups that we want to be in going into 2013. We're going to kick it off with the Qs, because we think that we're going to see a lot of CapEx spend in 2013. We're going to see a significant upgrade cycle where that cash is put to work to move on to more equipment, more technology, and really go into that upgrade. So we're going to look at names like the tech space. We're going to look at names like the industrial space. Let's kick off the Qs and see how we did for 2012 and some ideas going into 2013.
Technology has been such a mixed bag this entire year. What I was happy about was that it actually showed us how weak the market was in October, so you didn't get caught in that down move that we saw. But recently, Qs have been in line. Then it's not giving you a blockbuster move, but it could change for next year as we do see some of these upgrades in that cycle. You look here at the chart, you have a few points of reference. So here is that same type of low on November 16th. By the way, this is when it broke this pattern here in October, well before some other indices, especially the S&P, so that gave you some clues to lighten up. So right here, here's your reversal. You look at this line of support. I think short term, this is what guys are trading against. If we were to see a break below, just say 64.50, I think that wouldn't be a healthy sign for the market. The longer we go sideways and hold this, I do think the better the chance that we fill this gap from Friday and we continue to the upside. So at least we have a predetermined support level that you could see right here. Right now, it's not outperforming the market, but we're going to need to see if that changes. And the way that's going to change is if it could start to break above, just say this 66 area. So, this is your predefined levels as we move forward.
Moving along to the financials, the ETF for this is XLF. I think some great spaces to be in for 2013 include the online brokers, the payment processors, and the regional mortgage names like your Wells Fargo, like a Key, as we see some housing recovery continue in Q1. We have a lot of low inventory, and you have some more normalized prices in terms of housing.
Right. So on the financials, they've since the start of this year they were a good spot, and then during this rally from November, it's been a very specific tape or trade, so to speak. And within the financials, we've had a lot of nice setups. So if you take a quick look at the XLF, you will see here that this was a nice move. Okay, this is when it broke this little downtrend right around here, coming into this 1590. Here's your channel, and then look at this, enough power to break to new highs on the year. A lot of indices did not do that. Financials did. So recently, this has been a spot to be. So at this particular point, I think, support-wise, if we were to get hit, if something doesn't happen in the next few days with the president coming back from Hawaii, this is crucial support around 1613. But I do think if we hold above this breakout area, you're going to see a lot of power going to 2013, and we'll go over some of those names in a little bit.
Coming back to the CapEx theme, and also we're going to be looking at global exposure, European and emerging as well. We're going to look at the XLI, which is the industrial ETF. The top 10 names comprise 50% of this particular ETF. Your names like your Honeywell, your GE, your 3M, that do have that U.S. exposure, but also have a lot to China, to Europe, to the emerging markets. And we think that's going to be really key in 2013.
Yeah, and this one actually showed you relative strength like the financials. Broke to new highs before the S&P, broke to new highs before the Qs and technology. So whenever you see relative strength, that's how you create alpha. And you just had a small pullback because the market just had a 2-day pullback. If you look at the chart here of XLI, you will see that not that big of a deal. This is when it broke above this recent downtrend, had a little bit of power, came back, retested, which is good. So I think at this particular point, I think it would be healthy to get rid of this gap. I hate open gaps because typically they add pressure to a situation. So here's your short-term support in this ETF right here, right around 37.40. I'd like to see a trade above 38, close this gap. And then over some time, going into the new year, like you said, with the whole fundamental thesis behind it, I do think you go to your monthly chart of the XLI, and you will see we are just on the verge here, the verge of breaking above significant resistance. We break them and close above this with some new funds into the new year. This high here, way back from 2007, I don't think will be a problem.
Moving along to XHB, and this is a theme that we spoke about in the beginning with the financials. We think that we're going to see the home builders and even lumber companies or even the home builder retail derivative names pick up some speed again in 2013 as we see the continued housing recovery play out.
Yeah, and this has been a place to go. We talk about it all the time. It definitely gets a little price specific at times, but right now it's trying to break out. It's showing relative strength. It's been hard to find momentum in this market, so don't be alarmed that it's not just gapping up through highs and going. We're not seeing much of that right now at all, but overall you're seeing relative strength here. You take a look at the chart of the XHB, I'm sorry. Here was, the support. If you look back in, November, this was that low. Then you had a big gap up, held higher. It tried to break out, in this area. It didn't have enough energy. Last time we talked about it was this nice little tight range, still holding above it. So out of this, last, just say range, I would say micro support 26-ish. The longer you hold above 26, the better the chances coming into the new year. This is one of the first groups like the financials to get through those highs. So, there are stocks in that group that will give you alpha, but that's another thing we'll go over later.
And let's wrap it up with MOO. This is the agricultural ETF, and this is something that Scott and I have been speaking about for 2013. One of our favorite names going into Q4, and then also we see a real big theme playing out in 2013. For you real long fundamental holders out there, we're expecting the world population to go from 7 billion to 9 billion by 2050. A lot of names to feed. That means farmers really need to increase their yields from crops. But again, going right a little bit closer to 2013, we have a lot of cash within this group. We have the Cargill lockup coming up in Mosaic, so we'll see some cash put to work there. So I think you'll see some nice M&A in this space. And once we sort of resolve the China-India contract issues, there could be a lot to look at.
Yeah, I think this one you really have to, it's more than charts. You have to educate yourself on the longer term picture, because I know for me, it's been very erratic where they look good and then all of a sudden boom. So you have to be very specific, and this year there were 2-3 times to really focus on the ags name and create some alpha, but then you have to trade around your positions. And if you look at the chart of this ETF for the ags, you had a nice broke above this downtrend right here, broke above, held, but then look what could happen to you in 3 days if you chase a move and if you're not comfortable. Within 3 days you had about 2 weeks worth of work just taken away. So that's why you always use some type of tier system where you buy some, you sell some into strength, and then boom, you're not so upset about a 3-day pullback like this. So right now, it broke to 21-day, which a lot of other ETFs haven't, but the ags do that type of thing. Short-term support you have here at 51.71. I'd like to see it do some work above, this 51.71 area for it to continue. And then if you're looking for names, you have to be very educated on what's coming out of them, and there's no one better than Jill as far as this group.
All right, and we'll take a look at some of those names when we come back from this quick commercial break.
Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Welcome back to the morning call. We're going to dive into the trenches and take a look at some of the individual ag names. We're going to kick it off with Mosaic, which was one of my favorite picks for 2012, really seeing that seasonal thesis play out in December. And I also think it's going to be a key theme going to Q1 of 2013. Some key dates in the near term to pay attention to are the USDA reports that come out on January 11th. You'll see a lot of volatility and some nice momentum in trading opportunities in this name. Back to Mosaic. This is the strongest one in the phosphate and potash space. We're going to see the cargo lockup come up in May, which is not going to be dilutive because these shares already exist. They have the ability to buy back shares. They have the ability to increase the dividend just like they did in 2012. And we're really going to see cash put back to work following that lockup in May.
All right, well, with all that said, there's been places and times to be in and times to be on the side. If you look at the chart here, you'll see, I remember when you focused on this coming into the end of the second quarter, what a great focus coming into the end of May. Here was that red dog reversal right around the end of May into June. Boom, very nice move to the upside before coming back in, which a lot of these ags do. From here, that November bottom, you had a gap up that held, continued higher, pushed through this little downtrend, pushed through a lot of the moving averages, and it's holding higher. I think as a trader, if you're not involved with this name, take a look at it. As the longer it stays above this recent area, especially the 21-day right here, if it stays above this 54-ish area, you could see some momentum above 56. So as a trade, it starts getting above 56 and holds above it. I think your next move will be back to where it stalled out, right around here at 62. Then if you want to take a look at the weekly chart for 2013, so to speak, you're seeing, what's going on right here. You see a downtrend, coming into place. And if it does, this is a nice little level here. It does get above this 57 area. You have 62, and then a more macro resistance area comes in the low 70s for 2013.
Moving along to Monsanto, ticker MON. This is about genetically modified seeds. And if you remember anything from the summer of 2012, it was a severe drought that we had in the U.S. And in particular, the global situation wasn't that good either. Weather trends is the biggest variable when we look at the ag space. But something really interesting I read over the weekend, 107-year-old investor Irving Kahn owns Kahn Brothers. His favorite space is ags, and MON in particular. He started as a runner in 1928 on the floor, and he still works 5 days a week. So if someone with 84 years of investing experience likes the space, you pay attention to it.
See, it shows you a little bit of the American dream as well. Yeah. You could start off small and end big as long as you put the time and effort into it, which is something I wish America had a little bit more of now, a little bit more hustle. That's something we're missing. That's a whole other subject. But as far as Monsanto, I like to see stocks that are showing relative strength, stocks ready to make 52-week highs. You look at Monsanto, it's been one of the leaders all year. Look where it was. Look at this was that reversal come November, or this was on November 15th, actually even a day before the rest of the market, giving you a leading indicator. And then from here, we made highs, held higher, right near the highs here. This stock gets above 93.13 and holds above it. It could go again. And then you look at the weekly chart of Monsanto, and you'll see that this has been one of the best stocks. And you know what? Go back even further here. So you see some macro resistance. So for 2013, look at this major level here. This clears 93-ish or so, and you don't see any real resistance until about 110. So I think this should be on your focus short and intermediate / long term.
Moving along to the nitrogen-based producers, we'll take a look at AGU. This name is up 50% year to date for 2012. You look at names like that have shown relative performance, and they're still going to have that momentum going into 2013. As again, with this space, we're looking for increased crop yield. So we'll see that with an AGU. Next, we'll also move on to a CF following along the same themes.
Yeah, this one, it's very choppy. So it's hard to understand. Sometimes I know traders sometimes take it long and they get news and this and that, but it follows trends. And if you look at the trend here of AGU when it was a lot stronger, from the low here, it continued higher before finally, giving way on this huge gap down. This was actually surprising, it looks like, in my opinion. It was hanging out up here above the moving averages, and pow. From there, tried to repair some of its chart, came into a lot of this gap, and then you had a potent down day here, and since then it's been out of play. I would say for this type of stock, if you're a trader, not much to do until it starts getting above this 103 area. Starts getting above 103, it can get back in vogue. You look at the weekly chart of this situation, you'll see that this too, overall on the weekly basis, it's fine as well. So, but again, 103 is big resistance, and then you have the high area about 108. If you want to be in it, because you're a fundamental individual, just have half now and then wait for it to get into motion if you're a believer in the name.
And finally, let's wrap it up with CF, sort of the same fundamentals, and it's been one of our favorite names to trade here, because one thing with the ag names is that there is a lot of volatility within this space. It's a very seasonal type of trade, but once they do get in some sort of trend, whether it's up or down, there really are some significant patterns there.
And you just need to know what's going on. I know for a lot of the stocks that I trade, there are less things that could throw a curveball at you. With the ags, it's weather, it's crop reports, it's all these things, which if you're in this group, you just have to be a bit more in tune with the fundamentals versus just the technicals, because all of a sudden you don't know an important date's coming out, and you could be sideswiped, so to speak. And if you look at this chart, this stock to me has usually with like a Monsanto, has been really strong and providing leadership. And then it broke right here, came into the 200-day, reversed up, and then, this was a pretty, harsh 2-day decline right there. I guess this could have been when AGU happened, but here was your potent down day, engulfed this little range here, then you had to follow through to the downside, and then it crawled back up, found resistance, and, at this point, it's somewhat out of play. I don't know what it's going to take as a catalyst to get back going, but to me, as a trade, it doesn't look that compelling
compared to Mosaic or right.
Yeah, just like it's not tight. Some patterns are tight, and some give you points of entry that are easier to define. I like defined points of entry with risk defined. This one just seems a little sloppy for now.
Well, it's funny because over the holiday weekend they had trading places on all weekend long, and I just kept thinking of how we talked about the ags for 2012 and seeing the way it was traded then, open outcry relative the way it is now. So I mean, the NYMEX, there was a lot of volume there. Moving along to quick hits for quick cash, we're going to kick it off with GLD. It's the gold sector ETF. Since the QE4 announcement, whatever we're on right now, gold's come in about $100, as did the ETF.
Yeah, this one was acting very poorly. I know about a month ago I tried to be long silver, and then that one day we got sideswiped. Just for educational purposes, you look at the chart of the GLD, and you will see here, someone always knows something, okay? And I was trading, or the metals looked okay right around here. You had a breakout to the upside. It looked like it was getting back into play. Tried to hold through during this 2-day process, and then bam. Like, I remember that market. Pre-market, it sliced through major supports and then never found a friend. And then what did it do? It broke through key support right here. And then from there, you had follow through to the downside. And then if you look at where it broke out from August, that's where, you see a small reversal. From there, 3-day bounce, nothing so crazy, I would think. But still, the metals have a lot to prove. I know a lot of gold bugs are frustrated traders. Have had a little success. This was like one of the, I would say, easier time frames to trade it before it wound up giving away to these moving averages again. At this point, I'm not involved. If you're caught in it, watch this 162. If it can't get back above 162 on GLD and turns lower, I would still think that it should stay out of the way or maybe even short.
Moving along to Boeing, and we typically don't talk about the aerospace defense names because they don't have as much momentum trades in them, but for Q4 we saw a lot of them move, and there's been some really nice trades in there. We saw a little bit of profit taking, but there's so many different sectors and spots to pick, just like we've been saying.
Well, I think that if you're going to be bullish on 2013, you have to look at names that are weighted within some of the indices, and I know Boeing is not really a great trader. But if you're looking to have a macro portfolio and you want to put something in that has a really nice pattern, because I remember this year, I never really traded Walmart, but I saw that huge decade-long channel. I said above 62, could probably see 72 to 75. Didn't know if it would be this year, and it was. It traded above 62, went to 77. You look at Boeing's chart, okay, which looks like a choppy mess, so to speak. But you're taking a look at the long-term chart here, from 67, okay, to I guess this was you can even take that out of the way, that breakout failure. This is almost a full year that it's within this channel, so to speak. It's coming to the upper end of it, so I do think above 77 to to just say 70. What is this? This little point here is to 78. you then see a breakout and go. We take out these highs here. I would say you look back at this segment that we're talking about today. I think Boeing could be 83 to 85 next year.
Moving along to IBM, and this is one of my favorite core portfolio holdings. We've had a big theme this year with companies initiating special cash dividends because of the fiscal cliff language that we're trying to figure out what our tax situation is going to be like. But if you look at a name like IBM, which has taken up its dividend 13% for 2012, it's bought back shares. It's continuing to invest in growth areas like services and analytics, which is 80% of their business lines. This is a kind of name that you can hold forever. But there are some nice short-term opportunities in there as well.
That. Listen, IBM for the past decade acted so much better than just say a Cisco or an Intel or some of those other behemoths. The Microsoft have reinvented itself many times. I traded from time to time. I know in the beginning of the year it was more clean cut. It was trading technically better. Then with its exposure to Europe and maybe the public sector, people got a little scared about some of the quarters. And then recently they found they had a softer quarter. And if you look at the chart, you'll see here that what I just don't like about the chart, and it could change, very, very quickly coming into next year, is the hole right here. There's expectations that there was a lot of love in this stock, gap down, lost on the moving averages, continued lower. Since then, it's tried to come back up. I just think, you just have to be a little careful. You can't say this is a stock that you want to own forever, because forever is a long time. At this point, you have a small uptrend in place. If you're not committed to IBM, if IBM were to start to break back below 190, I would say be careful, because you still have this big open gap that, in my opinion, is in the control of the direction. And yes, it's trying to repair it, doing some work down here. But overall, they have a lot to prove next quarter. And here's your pole. Here's your flag. This could be a pretty big, a bear flag. So at this particular point, 190 is pretty important support, but really, this 185. And if for some reason IBM starts to break below 185, you look at the weekly chart, you will see that this, here you go. Look at this right there, that wide range bar, directional. Only took back a third. So that's still showing me a little bit of pressure on this stock. So here's your area. Here's your support, and just know your time horizon, because to me, I think right now, IBM, has a lot to prove in the next quarter, and if it doesn't come in, where the street wants it, you could see more downside.
Right. Well, if you have a more longer-term perspective on it, you do have that nice dividend, and you're going to be paid to hold it. So there's something in there for everybody, which is a great thing. We spoke about the financials and how we saw some nice relative strength in 2012 and also into 2013. Now, Bank of America, which the move that it's had has been unbelievable. Yes.
I'm sorry, I have a little tickle in my throat. I guess I get tickled when I talk about Bank of America because, it has been such a good mover for a lot of the people in our community this year. You look at the stock, you look at the two recent moves. This was actually the weekly chart. You go to the daily. Last time we got very excited about it was right around here, around 995. Nice move to the upside, consolidated again, gave you a nice trade above 1071. Look at it now. We just saw that 2-day down move. Bank of America took it in stride, another bull flag. I wouldn't say at this point, if we start to clear 1152, don't get the same type of size as you took here or the same type of size as you took here, but stay with it. I'm still long Bank of America, and I do think, you look back at the weekly chart, it broke above a really key level, and I do think that at some point this year, 2013, there's no reason why I can't see 14 to 1450, which is another 25-30% in that name, and it's liquid, and there's a little dividend.
And you trade look at the housing
options
recovery
around it. Right. Yeah, I think it's a great name to stick with.
Moving along to Apple, and this has been really interesting because for the past 2 years, people have made careers just trading the stock alone, and the markets really have moved in tandem with it. It was such a everything moves so relative to it, but we're not seeing that anymore. And I also think what's interesting to note with the markets is if Apple's having an up or down day, or down in particular, the market's still performing regardless of that. I think that's really key.
Right, that they're trying to put Apple on the side and money's flowing elsewhere. So if money comes out of Apple, it goes into other places, and you have to find out where those places are. As far as this stock, it should be on everyone's radar. Right. Because people have long-term investments in it, hedge funds are in it, you name it, they're in it, traders are in it in all different time frames. For me, sometimes it's easier to stay with when it's trending, and then sometimes it's just a two-way trade, and it's a little bit too dangerous. And at this particular point, it's coiling for one of those type of moves again. If you look at the chart of Apple, which is never a quick hit with me, it's always a long hit. If you remember, those on my virtual trade floor, this was a nice trend. This was the 2 quarters ago, came down, filled the gap very quickly, held higher, and then from there, you had a methodical move following the 8 and 21 day all the way into the iPhone 5 release into the highs here. then even if you didn't sell the high, this was your spot when it broke the 21-day and closed below it. Said on that day, I think with Kramer, breaks below the 21-day, we could see the 50-day. Well, we saw the 50-day, and then you judge it again. From there, 3-day feeble bounce to close below it, which then gave you another move down through the 100-day. From here, couldn't even find another friend at major support, continued lower to the 200-day, broke below it, couldn't rally back above it. Then finally, you had that outside day right here, which got controlled by this downtrend. They got failed by the 200-day. From there, down much quicker than people would have thought, saying, again, weakness. And then here, it's consolidating. Look, it's right by this danger zone. So you want to take a closer look. I know I'm long a little bit, but I'm going to have a very tight stop. If this thing just starts to break below 515, I'm out of the way. If it starts breaking below 510, I think guys are going to be looking to get a juicy short below 505 to 501, because if you do get that, you go to your weekly chart, there's really no support until about 486 and then 440. And then you have the elephant in the room that everyone's talking about is this weekly head and shoulders pattern where you have the left shoulder, the head, and right now we're in the process of making this right shoulder, and right around here is that neckline. So at this particular point, just know that you can't close your eyes and hold Apple forever if that's the case. For a constructive scenario to take place is, hold above 515, start to break above 524.25, which was Tuesday's high, and then clear this little downtrend. Scare some shorts, make people think that they're missing something in Apple, because they haven't missed something in Apple during this decline since October. And then again, another big resistance comes into place around 550. So at this point, I would take incremental steps to approach Apple. Don't look at it with Apple rose-colored glasses.
Right.
But again, we just had Christmas, and my son got a Nobby from a relative, and and a Nook, and he's only 4 years old, and he knew the difference. He's like, "No, mommy, I want your iPod. or your
iPad.
Your iPad." And there was a big difference in the quality of all of it. And I think the products are great. I think, unfortunately, between social media and the media, everyone's just Apple, Apple, Apple. They're scaring too many investors out of it. They're creating a more of a punching bag versus an investment. The PE's low. The products are great. The supply issues aren't as big as they were. Unfortunately, like I've said so many times, split the damn stock.
Right.
Otherwise, I think the street's going to split it for them, and who knows what will happen from there.
Right, well, it's too capital intensive for the average retail investor to get involved with. And I think what people are going to really have to look for in Q1 is conversation around margin compression and market share.
Right.
Because that's really what the big concern is, especially global market share. Let's wrap it up with Facebook. I'm actually surprised that it's reached the levels that it has to round out 2012, but...
it gave us a nice move. Last lockup, 800 million shares, it acted well, then it traded above 24, and now it's trying to consolidate. I know for my community, or for me, it was a nice trade right around here on the chart. If you look right when it went above this 24, this was the gap I wanted filled, went a little bit further. Since then, it's been choppier, but it's holding higher. Nice flag type pattern, showing some commitment to these higher levels. I'm long some. For it to really get so quote unquote frisky again, it's going to have to get above this 28.80, close above it, and then perhaps you see a move to about 31. At this point, being very small, here's your support to trade against. I would trade against this 26.12. As long as it holds above this 26 area, it's in the game for another additional move. It's just digested a really nice move from the $20 area, and then the pivot here at 24.
All right, well, we still have a lot to look at going into the end of the year. Trading's going to be a little bit thin and choppy, but there still are plenty of opportunities. Catch Scott at the end of the day as he wraps up the charts for us on Options Profits, Real Money Pro, and T3Live.com.